Most people think gold and silver are always safe. It is perhaps the single oldest rule in the history of money. When the world catches fire, you run to the metals. But that simple, comforting belief has actually caused many people to lose substantial amounts of money. It sounds contradictory, doesn't it? We are told that gold is the ultimate shield. Yet history is littered with investors who bought the right asset at the wrong time for the wrong reasons. Today on Crucible Markets, I'm going to dismantle the myths. I'm going to explain exactly what the average person gets wrong about precious metals, and I am going to do it in very simple, practical terms. Gold and silver have been used as money for thousands of years. Long before the US dollar, the euro, or the yen existed, there was metal. Because of that deep history, people trust them on a primal level. They feel real. They have weight in your hand. They feel safe. So naturally, when stock markets start to tremble, when inflation numbers begin to climb, or when geopolitical tension makes the world feel unstable, the average person's instinct is to rush into gold and silver. But here's the problem. Most people fundamentally misunderstand how gold and silver actually function in a modern, digital economy. There is a specific belief that gets most people into trouble. I want you to be honest with yourself right now. Have you ever thought this? Gold and silver will always protect my money, no matter what. Or perhaps prices only go up when the economy is bad. If you have heard that advice before, or if you believe it yourself, go ahead and hit the like button right now. It helps us see just how common this narrative really is. On the surface, this belief sounds logical. It feels intuitive, but it is incomplete. And in finance, an incomplete map will get you lost. Gold and silver are not magic shields. They do not protect you in every single situation. And crucially, they do not move the same way, at the same time, for everyone. There is a massive difference between feeling safe because you hold a coin and actually being financially protected. Many people buy metals thinking they are opting out of the financial system entirely. They think that if they buy silver, they are immune to the movements of Wall Street. This is a trap. The price of your metals is still determined by that very system. Here at Crucible Markets, we want you to understand the nuance. We want you to be on the right side of the trade when the panic sets in. To understand the mistake, we have to look at the real purpose of these metals. Gold and silver are not designed to make you rich quickly. If you are buying them expecting to double your money in 6 months like a tech stock or the latest cryptocurrency, you are in the wrong asset class. You're trying to use a shield as a sword. Their main purpose is much simpler and, honestly, much more boring. They are designed to protect purchasing power over very long periods of time. They act as a counterbalance to the devaluation of paper currency. Think of it this way. In the 1920s, a finely tailored suit cost about 1 ounce of gold, roughly $20 at the time. Today, a finely tailored suit costs roughly $2,000 to $2,500. And guess what? That is still roughly the price of 1 ounce of gold. The gold didn't make money. It didn't generate profit. It simply preserved the purchasing power that the dollar lost. The number of dollars changed, but the value of the metal stayed constant. Quick question for you. Are you buying metals to get rich or to stay safe? Type the word safe in the comments if you are here for protection. Type profit if you are here for gains. I want to see where our community stands on this because your goal dictates your strategy. You see, these metals work slowly. They work quietly. They are the tortoise, not the hare. And this is where most people get confused. They treat gold like a lottery ticket. They buy in January expecting a boom by March. And when prices don't move the way they expect, or when the price stays flat for 3 years, they panic. They get bored. They sell. And here's the part almost no one talks about, the part that shocks new investors and causes them to sell at the absolute bottom. Gold and silver can go down significantly, even during a major economic crisis. And let me explain why, because this is the specific trap that catches people off guard. During moments of extreme financial stress, like a market crash or a global pandemic, investors do not act logically, they act on fear. But more importantly, big institutions face something called a liquidity crisis. When big hedge funds lose billions in the stock market, they get margin calls. They have to pay their debts immediately. They need cash, and they need it right now. They can't sell their real estate. That takes months. They can't sell their private equity. So what do? They sell their most liquid assets. They sell what is easy to sell. They sell their gold. They sell their silver. They don't sell because they want to. They sell because they have to. This is why, at the beginning of a crash, you often see stocks falling, and gold falling, and silver falling, all at the same time. Cash is king in a crash. We saw this in 2008. We saw it in March 2020. The world looked like it was ending, yet gold prices dropped initially. Retail investors look at this and say, gold failed, silver doesn't work, the markets are rigged. But that is not true. They are judging a long-term tool using short-term panicked behavior. If you understand this mechanism, you won't panic. You will realize that this dip is often the last great buying opportunity before the real flight to safety begins. If you want to navigate these market traps without losing your cool, make sure you are subscribed to Crucible Markets. We break this down every week so you don't get caught off guard. Now, let's address another massive misunderstanding. Many people think gold and silver are twins. They think they behave the exact same way. They do not. Gold is mainly a monetary metal. It is a store of value held by central banks. It is the grandfather of assets. It is relatively stable. It is the ultimate insurance policy. Silver is different. Silver has a split personality. Yes, silver is money, and it has been for thousands of years. But silver is also a massive industrial material. It is in your iPhone. It is in the solar panels on your roof. It is in the batteries of electric cars and in medical devices. Roughly half of all silver mined is consumed by industry. This means silver is much more emotional. It is sensitive to the health of the economy. If we enter a recession, factories shut down. They build fewer electronics. That lowers the demand for silver. So you can have a weird situation where inflation is high, which is good for silver, but the economy is crashing, which is bad for industrial demand. This tug of war makes silver move faster and more violently than gold. It goes up much higher than gold in a bull market, and it crashes much harder than gold in a bear market. Gold is the calm older brother. Silver is the volatile teenager. When people treat them the same, they get disappointed. They put their life savings into silver thinking it is stable, and then they can't handle the 30% swings in price. This leads us to the critical mistake of timing. Because people view these metals emotionally, they almost always buy them at the precise wrong moment. Think about when the average person buys gold. They buy when prices are hitting all-time highs. They buy when their neighbors are talking about it. They buy when the news headlines are screaming about the end of the dollar. Basically, they buy when fear and price is at its peak. This is often called the fear of missing out, or FOMO. And usually, right after fear peaks, the price cools off. The news cycle calms down. Prices stop rising. Maybe they fall 10 or 15%. And what happens? The same people who bought in a panic now look at their losses and sell in disappointment. They buy high and they sell low. Does that cycle sound familiar? We have all seen it happen. Gold and silver reward patience. They punish emotion. The time to buy insurance is when the house is not on fire. But most people wait until they smell smoke to call the insurance company. So how do you fix this? What do the smart investors, the ones watching Crucible Markets, do differently? They understand three very simple ideas. Number one, they view gold and silver as insurance, not lottery tickets. You don't buy car insurance hoping to crash your car just to get a payout. You buy it so you are protected if something happens. Number two, they measure success in years, not weeks. They don't check the spot price every morning. Number three, they use metals to balance risk. They don't put 100% of their money into silver. They usually hold between 5 to 10% of their wealth in metals. They are perfectly happy if the price does nothing for a while, because that means they are still accumulating insurance at a good price. This mindset changes everything. It takes the anxiety away. But there is one more layer to this. If gold and silver are so misunderstood by the average person, then ask yourself, how do central banks and large institutions actually use them? Why are countries buying gold at record rates right now? The answer might surprise you. It has nothing to do with trading and everything to do with power. In the next video here on Crucible Markets, I'm going to explain specifically how governments really think about gold and why their actions matter much more than the price headlines. If this video helped you think differently, please hit that subscribe button and turn on notifications. We are building a community of clear thinkers here, and I'd love for you to be part of it. And tell me in the comments below, do you own more gold or more silver? I'm curious to see which team has more fans in our community. Thanks for watching Crucible Markets. Stay skeptical, stay prepared, and I'll see you in the next one.